Domestic mutual funds have been acting as a strong counterforce against foreign portfolio investors or FPIs selling off Indian equities. For the second consecutive financial year, net flow in equities by MFs has crossed the 1.5 trillion rupees mark. Analysts believe this strong show is likely to continue in the next fiscal year as well. Between April 1, 2022 and March 1, 2023, mutual funds pumped in a net 1.53 trillion rupees in equities, according to data provided by market regulator SEBI. This comes after they pumped around 1.72 trillion rupees in equities in FY22. In comparison, FPIs have withdrawn roughly 36,538 crore rupees in the equity segment so far in FY23. This, however, is better than the net outflow of 1.42 trillion rupees, which was recorded in FY22, NSDL data shows. According to Swaroop Mohanty of Mirae Asset, the strong inflows are a reflection of India's strong economic growth.
I think two major data points which are driving this positiveness of the market. First being the data points of India definitely stand out. I mean, when you look at power consumption to four-wheeler consumption via, say, GST collections, the data points are there for everybody to see, and that gives the confidence to Indian investors. And secondly is the great change that has come about in the sentiments or the behavior of the Indian retail investor towards Indian equity markets. I mean, look at 13,000 odd crores going into the markets in the form of SIP every month. That changes the structure of the Indian equity market, and that is what is giving a lot of comfort to the market on the downside.
Data 2 backs Mohanty's analysis. Except in FY21, mutual funds have been net buyers in equities since FY15. In the past 9 financial years, between FY15 and FY23, MFs have pumped in nearly 6.9 trillion rupees in Indian equities. So, how does the road ahead in FY24 look like?
2024 will be a little different. I mean, I come from the fact that there could be a possible slowdown of the Indian economy towards the end of the financial year 2024. And to the fact that investors or the first-time investors who came into the markets over the last 1.5, 2 years have not been making money from the market. And thirdly, the data points that are coming out from the rest of the world are not exactly strong. The world today is in a very fragile state of affairs, and any time these data points could definitely create a fair amount of disturbance in the market. We see a blip of it now and then, so this will start playing on people's mind as these data points progress. So I suspect towards the second half of financial year 2024, we might see a little bit of a slowdown from investor inflow into equity markets.
Outlook for FPI flows too remains conservative for 2023. According to Kunal Vora of BNP Paribas, FII holdings in the Indian market are close to the lowest in a decade. With China reopening and India's elevated valuation premium, we see a risk of FII outflows continuing in 2023. That said, India's sharp focus on capital expenditure and a resilient economic momentum won't be able to keep it off investors' radar for long. On Tuesday, the markets will remain closed on account of Holi.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.